Assalamu alaikum. Welcome to the first ever lecture on UK tax, and this is for the latest syllabus that is applicable from June 2025 to March 2026 exam. We are following the new Financial Act, that is Financial Act 2024. This is the first ever lecture under the Financial Act 2024, which is applicable from June 2025 till March 2026. I have also introduced you to ATX. Okay, I've also introduced ATX with tax. Same from June 2025 to March 2026. The only difference for my ATX students are my ATX videos will not be there on YouTube for free. You have to purchase the ATX videos, my recorded lectures, you can purchase them. And the ATX and the tax slides you can also purchase from me. All you need to do is email me or WhatsApp me, and I will give you the details to purchase the lecture slides for ATX and tax, as well as the recorded lectures for ATX. But the tax will be there for free on my YouTube channel. You will get it under the tax playlist. And total there are going to be 22 lectures on tax. So this is the first lecture introducing you to UK tax for the ACCA students. So isn't this a great package for this upcoming exam June 2025? Why not subscribe to my channel and get all the notifications, and also inform your friends. So let's start. First lecture is the UK tax system. It's like an overview of all the types of taxes in short. This is not a detailed into any one topic. That will start from lecture 2 onwards. This is introducing you to UK tax system. And so let's start. Here we are going to focus on what is the scope of the syllabus. Under the scope of the syllabus, what is the purpose of tax in the economy? What are the relevant taxes that you need to study in this syllabus? How do you tax income gains? Income tax, CGT, capital gain tax, inheritance tax, corporation tax, VAT. So these are the 5 types of taxes that we are going to study here, and they are different from each other. The way we calculate these taxes are different, the purposes are different, and remember, if you are planning to take ATX in the future, if that's your optional paper, you have to be very good in tax. You have to be very good with all these 5 type of taxes. Why? ATX is nothing new. It is just the upgrade version of this with more complex situations to income tax, CGT, inheritance tax, corporation tax, and VAT. All of this will be tested again in ATX in more advanced level. So you have to be good in the basic level, okay, if you want to be good in ATX. Now, what are the taxable period? This is the period when your income or gains will be taxed. What is that period called? Okay, tax years for personal taxes. If you're personally paying tax as an individual, it is known as tax years. Accounting periods. If you are a company, you are paying corporation tax. Companies pay corporation tax, individual pay income tax. That is known as accounting periods. Then for VAT, which everyone pays, company or individual, it is known as tax period. We are going to go through the difference in each one. Next, tax status. Very important is the tax status. What is the residence of that individual? If you are a UK resident or you are an overseas resident. What is the residence of a company if you are a company? Are you a UK company or an overseas company? Very important from the point of tax. Because based on that, you will be charged on UK tax or exempted. Next, double taxation agreement. Then UK tax, how it is administered. What is the structure of UK tax system? What is the tax authority? Self-assessment. How do you assess? See, all the taxes are self-assessment, are done by you. You calculate your own income tax. Exception is inheritance tax. Okay. Then responsibilities to HMRC. Responsibilities of HMRC, very important. You have to know this. Because in UK, HMRC is the most important for your income tax. They collect the tax, they assess the tax, they go into the investigation. Then professional tax advisor. What are the role of them? Then tax avoidance and evasion. This comes in your ethics, tax evasion and avoidance. Aversion is illegal, avoidance is legal. They are like tax planning rules. Then we have general anti-abuse rule. Okay. Then what are the source of tax law? Tax law can come from your statute, from the case law, or from the HMRC statement of practice. See, all these things in detail you don't have to know the source of tax law, but for your MCQ, because tax section A MCQ, you have, they will be tested. This knowledge will be tested there. That's why you need to know. So here we are going to go through the summary and the technical articles, and also the syllabus coverage, how much syllabus we have covered from this lecture, and what are the technical articles one must read. Technical articles are very, very important in ACCA in all the level. You have to read them. They are there on your ACCA website. You'll get it there, where you get your past papers and questions. Past paper questions, you will get your technical articles also. You get your syllabus and all, technical articles are there. This is just an graphical overview of what I've just covered now. Okay. The main objective of this lecture is what? To cover all the concepts and all the principles of the tax that are going to be examined in UK and how it is administrated. So we started with the scoop. The 5 types of taxes comes under the syllabus. Then it comes from the sources, statute, case law, HMRC statement, and it is taxed for personal tax year, corporation tax accounting period, VAT tax period, and tax status very important depending on the residence of company, individual, and double tax. UK, it is administered by self-assessment. What are the important role of tax authority, HMRC responsibility, and professional tax advisor, and finally tax aversion and avoidance. You have to know the difference, very important. And the generally anti-avoidance rule. Okay. Now, so the tax has two main economic roles. Number one, it helps to fund government expenditure. Number two, it's a tool for macroeconomic management in influencing demand. You influence demand through tax. If you increase the tax, demand reduces. If you decrease the tax, demand increases. Fiscal policy. If you have studied economics, you will know this. Okay. Now, so tax is an important tool for a number of social objectives. Why? Because it is the structure of your tax system that can affect the redistribution of wealth. How the wealth. That's why if you see, rich becomes richer, poor becomes poorer. Why? Because rich knows various tax planning tools that poor doesn't know in the economy. Poor in a sense, I'm talking from the income wise, okay? Income. So, structure is very important. That's why we are studying the structure. Now, the UK tax system encourages these things. It encourages you to save. It encourages you to put it in the pension. Why? If you put money in the pension, you are going to get some tax incentive. Tax incentive means tax advantages. Maybe you have to pay less tax. Maybe your tax might be delayed. Maybe you might be given a lesser percentage of tax. They are known as tax incentives. Okay. Now, it encourages you to donate in your charity, because there are some advantages in terms of tax. And for entrepreneurs and investors, they are giving you tax relief. But it discourages certain behavior. For example, in the motoring, by imposing fuel duties. They impose fuel duties, they make transport very expensive, your mean of transport, and they give certain taxes on smoking and drinking, making it harder to consume. Next, tax policy can also impact green issues. How? They can impose climate change levy, landfill tax, company car taxes. Main aim is to reduce carbon emission. Okay, and the overall amount of tax revenue. What should be the tax revenue? Fundamentally a political decision. Now, so overall, the specific ways of raising tax revenue have to be considered. How are you going to raise the tax revenue? You have to consider. Now, one decision concerns the type of tax used. Taxes are two types. Remember, direct and indirect tax. Okay, direct taxes are those taxes. See, we are studying 5 types of taxes. Out of that 5, Four are direct and one is indirect. Tell me which one is indirect. Indirect is only VAT. All the other four types of direct taxes: income tax, capital gain tax, corporation tax, your inheritance tax are all direct taxes. Why? They are directly taxed on your income, chargeable gain, capital transfer. Okay, even your national insurance contribution are direct tax. Why? Because these taxes are directly collected from the taxpayer. Who are taxpayer? Anyone who is paying tax in UK are known as taxpayer. HMRC. And who collects the tax from taxpayer? HMRC. Know the relationship between HMRC and the taxpayer. They go together. Okay? For a tax to operate in UK, there should be an HMRC, there should be a taxpayer. Taxpayer gives the tax to HMRC. Okay, so HMRC directly collects this tax from taxpayer. That's why it's direct tax. Indirect tax is VAT, is only VAT. Why? Because HMRC collects this tax, collects from the supplier. HMRC collects from the supplier who collected from the taxpayer. There are mediums, two mediums. They do not collect it directly from the taxpayer. They collect it from the supplier, and this supplier must have collected from the taxpayer. First, the taxpayer gives it to the supplier, supplier then gives it to HMRC. So, supplier is collecting the VAT on behalf of HMRC from the taxpayer. Okay, and indirect taxes are applied on the spending on goods and services. It could be goods, it could be services. It could be to individuals, it could be to business. Now, most countries go for the combination of these taxes. They will go for direct tax also, they will go for indirect tax also. Okay. Now, one decision is type of taxes. That's gone. Second decision, what should be the rate of tax against the width of your tax base? Okay. So that is the next decision. So now, capital taxes and revenue taxes. There are two taxes. You need to understand the nature of this. Capital taxes are taxes on your asset that you have owned rather than earned. And revenue taxes are taxes on your income and profit. Tell me from the five type of taxes, which one are revenue and which one are capital? Revenue taxes are your income tax, corporation tax. But your inheritance tax and capital gain tax are capital taxes. That's why in your exam, if they ask you calculate capital taxes, they are asking you two type of taxes, inheritance and capital gain. And if they are asking you revenue taxes, means income tax and corporation tax. Okay. Now, so this table is very helpful for you to understand all the type of taxes. There are 6 tax. In fact, there are 5 in addition with NIC. NIC is also comes under tax. Whenever they say calculate all the type of taxes, do not forget national insurance contribution. In UK, every individual on their earnings have to pay national insurance contribution. But there are classes. If you are an employed, your NICs are different classes. If you are self-employed, your NICs are different classes. I will explain you briefly here, but in depth we have a separate lecture on this NIC. So first I will start with income tax. One by one I will go in this table. So income tax, understand whether it's direct or indirect and capital or revenue. Income tax is direct tax and it's a revenue. Corporation tax could be both capital and revenue and is direct. Capital gain tax again is direct but it's capital, as the word says capital. Inheritance is direct and capital. VAT is indirect. VAT is the old indirect tax and it's neither capital nor revenue. So you know VAT is the only exception here. And NIC is again direct and revenue. Okay. So once again, starting from income tax. All individuals, whether you are an employed, whether you are a self-employed, you pay income tax on your income. Employed people pay income on their salary plus other commissions or bonuses, whatever they are getting. Self-employed pay on their profit, income tax. And also if they have some investment income, like you are having a property, you are giving it for a rent, it's your investment income. On that also you pay income tax. Okay. Corporation tax. It is for companies, not individuals. Companies pay corporation tax on their profits and gains. And capital gain tax, it is when you are selling, disposing your, you are either disposing or you're gifting your assets, and not any asset, chargeable asset. We'll go through the list of chargeable asset. Why? See, some type of income, some type of gain, some type of profit are exempt from the tax. You have to know what are taxable, what are exempt. There's a big list, don't worry. You have to go through it and you have to know it. In short, you have to by heart it. But it's not very difficult, trust me. Do not panic right now. Okay, there are lists under income tax, what are exempt, what are taxable. Under capital gain tax, what are exempt, what are taxable. It's a list. That's why we say chargeable. So chargeable gain. If you are selling chargeable asset or you are gifting chargeable asset, then whatever the gain you are having, it is charged to capital gain tax. Fourth one, inheritance. As the word says, inheritance. Understand, inheritance means when you have inherited something from your predecessor, maybe from your father or grandfather or your aunt or uncle, anyone, you have inherited something, an asset, you have to pay tax on that. It's a capital transfer. Okay. Maybe you have inherited it as a way of gift. Someone is gifting you. Maybe, let's say your father is gifting you cash or a house, or maybe your father have died. On that, you are receiving the asset on behalf of your father. It's automatically transferring to you. So as a result of death or as a way of gift during the lifetime. Next, VAT. VAT are paid by almost anyone in the economy. You could be sole trader, you could be partner, you could be companies. You are paying VAT. On what? Again, taxable. It has to be taxable supplies. Why in VAT also you have exempt? Some goods and services are exempt from VAT. There is also a list. In fact, under every type of tax, there are list of exempt and taxable. So VAT on taxable supplies of goods and services in UK, you have to pay VAT. And if you are importing anything into UK, on that also you have to pay VAT. Next, last, NIC. NIC, earlier there was class 2 NIC. It is now removed from the tax syllabus. Now there is no class 2 NIC. Thank God. For self-employed, there is only one. Okay. And for, I will start with the employees. If you are an employee, you have to pay class 1 NIC. It is known as class 1. That is on your earnings. Whatever you have earned as an employee, on that you have to pay NIC. If you are a self-employed, I'm sorry, let's go to self-employed later. If you are an employer, okay, if you are an employer, you have to pay two types of NIC, class 1 and class 1A. Class 1 NIC, why? It is as an employer. And class 1A, 1A means for the benefit that you are giving to your employee. The employees are giving some benefits. Benefits in kind mean other than cash. You are giving a company car, you are giving them vacation, you are giving them fuel, you are giving them accommodation, you are giving them heating, lighting, paying for their expenses or rent, or giving them mileage allowance for them to travel to work. These are known as benefit, or some what do I say, medical expenses you are paying. All these are known as benefit, which an employer receives while they are in employment from their employer. But they are not in cash. If they are in cash, it's class 1. If it's not in cash, other than cash, it's 1A. So employers pay this NIC on class 1 for cash, 1A for benefits. Employee only pay 1, class 1. So under class 1, there are two. Class 1 for employee, class 1 for employer, and class 1A, obviously employer only will be. So gone. Coming to the next class, class 4. Self-employed, the ones who are having businesses, they pay class 4 NIC on their profit. On their profit. Okay, this is briefly I've introduced you to NIC. But in depth, I will explain you when we go through NIC once again. Don't worry. Now, income tax. So coming to the income tax. By the way, under this all type of taxes, the first tax that I'm going to cover is income tax. So forget about all the other tax. Forget about VAT, inheritance, CGT, corporation. Focus on income tax. Now, in UK, okay, almost all individuals who have any sort of income, some type of income, it could be £500, £1,000, they are liable to UK income tax. But income has to arise in UK, or income arises outside of UK. It could come from outside of UK also, but person who is entitled to that income is a resident in UK. You see, for the tax purpose, you are resident in. If you are resident in UK, receiving income from outside of UK, you will be chargeable to UK income tax. And if you are receiving any income in UK, you will obviously be charged to UK income tax. So any individual who is having any kind of income in UK is chargeable to income tax. You understand? Now, next, this is briefly I'm introducing. Second, capital gain tax. When we are studying also, when we are going through the lecture also, this is the same structure I'm going to follow. First, I'm going to finish all the lectures under income tax. Then maybe 3, 4, 5. Then capital gain tax. Then inheritance. Sorry, then cooperation. Then inheritance. And finally the VAT. Okay. So capital gain tax. Now, any gain. See, please see how the word changed. When it was income tax, the word was income. When it was capital gain tax, the word is gain. Okay. So any gain arising inside or outside UK, and the taxpayer is resident in UK, have to pay capital gain tax. See, if you are in inside UK, you have to pay capital gain tax. But if you are outside UK, you have to be a resident in UK to pay CGT. Inheritance. Next. This is when you are transferring a property to, okay. If you are transferring a property inside UK or outside UK, but if you are transferring it outside UK and the one who is transferring it as a permanent home in UK, it is transfer as domicile. Domiciled is a term which we are going to cover later on. Okay, domicile means someone whose origin is in UK. They could have other than UK also, but let's say they are domiciled in UK means their origin is in UK. How do we decide domicile in UK? Simple way, just check whether they have a home in UK or not, permanent home in UK or not. Because someone to be called a domicile of a country, they should have a permanent home in that country. No one just takes a permanent home in any country if their purpose is just to visit. Okay, if they want to stay there, if they are permanent there. See, domicile and resident are different. Okay, you could be domicile only in one country, but your resident could change depending on how much you are staying in a country for how many days. But domicile is fixed. It's only one. So let's say you have a permanent home in UK. So your domicile will be UK. So if the one is transferring that asset as a permanent home in UK means he's a UK domicile. And or he's transferring a property inside UK. Then charge to IST. Now, so the syllabus is confined to taxation of income and gains arising in UK and to capital transfers of UK property only. Thank God here we don't have the overseas aspect. Overseas issue will not come in tax, but overseas aspect will come in your ATX, advanced taxation. There we are going to cover this. Their domicile is very important. Here it might not be important because here everything is treated as it's in UK. That means you will be charged to IST. So you don't have to worry about whether it's overseas or UK. Next tax, corporation tax. Companies pay corporation tax on the income. See, corporation tax are on two types. Income also, chargeable gain together. Add them together. Okay, of a company. So income also, chargeable gain also. UK corporation tax is paid on both. If it's in UK, or if it's outside UK, then it is depending on the company residence. The company has to be UK resident. Okay. Now, VAT. VAT is for taxable supply. If your place of supply is UK, If it's from the place where you're supplying is UK, you are charged to UK VAT. Now, so we are finished with all the types of tax. Coming to the periods. If you are paying personal taxes, like income tax is a personal tax, then we take tax years. Okay. So what are the personal taxes? Three type of taxes are personal. Income tax, CGT stands for capital gain tax, and NIC, national insurance contribution. These taxes are known as personal taxes. Okay. So it could be for individuals, it could be for sole trader, it could be for partnership. They are assessed on the same time period. What is it? From 6th April. Remember this date, very important. Every tax student should know this. Your tax year runs from 6th April to 5th April of the next year. So for this year, for your exam purpose, your tax year is 2024-25. That is your tax year. And your tax year runs from the exam for which you are going to give exam, your upcoming exam, 6th April 2024 to 5th April 2025. It runs from this. This is your tax year. This is your current tax year. And IST, what about IST? IST will be assessed not on the tax year, depending on when you're making that gift or when the person dies. Because when a person dies, there are some implications. You have to pay some additional income inheritance tax. That we'll study later when we go through inheritance tax. Now you don't need to know so much detail. But the tax year 6th April to 5th April is relevant. Why? For the certain exemptions. Applying certain exemptions and for identifying when some tax is payable. Still you need this tax year. It's relevant. We'll see later. Coming to corporation tax. The ones where companies pay. That is known as accounting period, not tax year. This is 12 month. Okay. So a chargeable accounting period for any company is 12 month. It cannot exceed 12 month. And mostly company prepares their financial statement also for 12 months. Mostly you will see it is the same period of account for which company prepares their financial statements. But the period of account for which a company is preparing their financial statements could be longer or shorter than 12 months. See, the chargeable accounting period of the company cannot exceed 12 months, but the period for which a company prepares their financial statement could be shorter or longer than 12 months. And a financial year is different from tax year. Tax year runs from 6th April to 5th April. Financial year for company runs from 1st April to 31st March. The difference comes here. Do not get confused. This is your financial year 2024. So it starts from 1st April 24 till 31st March 2025. In fact, all your examples, all your questions you will see runs from this year only. Because rates of corporation tax applies to financial years. Sometimes your accounting period might not fall in this exact time period, right? Not every company will prepare from 1st April to 31st March. Some might prepare on 31st December. Some might prepare their accounts till 31st June. So some accounting period might fall in more than one financial year. Possible, mostly. Sometimes it falls in two financial years. That time you have to apportion your profit and apply different corporation tax rate. Why? Not every financial year has same corporation tax rate. But if you're lucky, they might be. That's why you have to apply different rates. That's why you have to apportion your profit so that you apply the correct tax rate to correct profit. Now, for VAT, it's a tax period. VAT are normally assessed quarterly on a quarter basis, normally for 3 months, and it's known as tax period. Now, tax status. So we are finished with the periods of all the three type of taxes: personal tax, corporation tax, and VAT. Coming to tax status. So whether you are a company or you are an individual, very important is what are you a resident in UK or not? Okay, so the tax status is determined by two. One is your residence, one is your domicile. Okay, if it is for the purpose of income tax and capital gain tax, both residence and domicile are needed. And if it's for IHT, only domicile is important. That means inheritance tax, only domicile. Now, If you are a UK resident, you are charged to your worldwide income. No matter wherever your income is, it could be in Germany, Japan, France. If you are a UK resident, you will be charged in UK to do on those income. Okay, you will be charged to UK income tax. But if you are a non-UK resident, you will only be liable to UK income tax on those income that arises in UK. If you are a foreigner, you are not a UK resident, you are earning any income, only those income that is in UK, arising in UK, only on that you have to pay income tax. If you are earning something in France, you don't have to pay UK income tax on that. Let's say you're staying in UK, you're earning income. While you are in UK, you are earning income from France. You don't have to pay UK income tax on that France income because you're earning it from France. But if it's in UK, you have to pay. Same for the company. For company, we don't need domicile, only residence. And in your tax, only residence rules will be asked. Domicile rule will not be asked. But in your ATX, domicile rule will be asked. Okay. So now the residence of an individual. So how do you determine the residence? There are some tests. There are three tests that you have to go through, three stages, known as statutory residency residence test. And there are some criteria that you have to fulfill. First known is first test, where you will be automatically be treated as non-resident. Second, automatically UK resident. Third, if you are having any ties with UK. Okay, there are some 5 ties that you have to go through each tie, whether you have this ties with UK or not. So you have to go through this test, these 3 stages in order. You can't skip the order. You can't first start with second or third or as you wish. No, first, second, third. And if you have met the criteria under the first test, you don't have to go through the second or the third. It is concluded there itself. But if you are not satisfying the first, you go to the second. If you're not satisfying the second also, then you go to the third and decide. Okay. So now, first we'll go through the residence of an individual. Okay, there is a table for it. First, it is automatic overseas test. That means automatically you will be a non-UK resident if you meet any of this criteria. There are three things. So if you are an individual, okay, if the individual was, by the way, you have to memorize these points. Okay, this requires a little memorization on your part. Otherwise, you will struggle a bit. Okay, how many days and all for you to stay in UK or not to stay in UK, for you to be treated as UK resident or not, you need to memorize it. You need to remember it. Okay, and suddenly it will not come in day one. You need a little bit of practice. So don't worry. Okay, now if the individual was UK resident in any one of the previous 3 tax years, numbers are very important. How many tax years? Previous 3 tax years. If any of the previous 3 tax years you were a UK resident and you have spent in UK fewer than 16 days, and both have to be there. You have to be a UK resident in previous 3 tax years, one of the 3 tax years, and you have to spend fewer than 16 days, less than 16 days in UK. You are a non-UK resident. You are not UK resident. Okay, and a day means we told 16 days, right? A day, if you are present in UK at midnight also, it will be counted as a day. Okay, if you are present in UK at midnight, it will be taken as a day in UK, one day in UK. Next, if individual was not UK resident in any of the previous 3 tax years, let's say you are not UK resident in any of the 3 tax years and you are spending less than 46 days, then also you are not UK resident. Or third one, you are working full-time overseas, you have without any break, and you are spending less than 91 days in UK. Or you are working less than 31 days in UK. Spending less than 91 days, working days in UK is less than 31, then you are a non-UK resident. So any of these three conditions are met. If you have not met any of these three conditions, go to the next test. Automatic UK resident. Here also 3 points are there. These days you have to remember, by the way, less than 16 days, less than 46 days, less than 91 days, and less than 31. Coming to the next. If you are spending more than 183 days during the tax year, you are a UK resident. Or if your old home is in UK, you are a UK resident. Or you are working full time in UK for any period for at least 365 days, that means at least 1 year, and at least 75% of your work days are in UK, then you are UK resident. Okay. But let's say you have not met the first test also, you have not met the second one also, then what do? You check the ties to the UK. You go to the third test for deciding a residence. Ties together with the number of days in UK, number of days spent in UK. Two things together. More the ties that apply, greater the number of days, more likely the person is to be a UK resident. If you have spent more time in UK, if you are having more ties with UK, you are a UK resident. You are likely to be a UK resident. So this table will help you. This table in fact is given to you in the exam. Okay, it's provided in your exam, in your formula sheet, in your tax rates and allowances. See, there are some good thing is some tax rates and allowances are given in your exam. So you don't have to memorize them. Okay, but just understand how it came. Understanding is a key. Then you can solve the question. We have a question on this that we are going to solve. So first we'll see the days in UK, and we'll see whether you are a previously resident or not previously resident is very important. First check whether an individual given in your exam, whether he's a previously resident or not previously resident. Based on that, we'll see days in UK. So let's say he have spent less than 16. A previously resident spending less than 16 days, automatically non-resident. And if he was not previously resident, also he's not resident. 16 to 45 days. If he was previously resident, he will be resident in UK if 4 UK ties. We'll go through this UK ties in the next slide. This is we are going through days in UK. Okay. Automatically non-resident. 46 to 90, again resident. Of course, if he's resident from 16 to 45 means from next rest all he'll be resident. For previously resident individual I'm talking about. Okay. So resident if 3 UK ties or more, automatically resident if 4 UK ties. 91 to 120, resident if 2 UK ties or more, resident if 3 UK ties. 121 to 182, resident if 1 UK, resident if 2, 180 or more, automatically resident, automatically resident. So this table will be given to you. Now, so application of the sufficient ties test. This ties test depends on whether a person has been resident in UK for any of the previous 3 tax years. If you are not previously resident in any of the previous 3 tax years, you can't apply this sufficient ties test. You have to be resident. Not in all the 3, but at least in any of the previous 3 tax years. Okay, so these are the 5 ties. You need to remember the ties. Family tie. Are you having a family in UK? Are you having a UK resident spouse or child who is under 18? Next, accommodation ties. Are you having a place to live in UK for at least 91 days? That means at least 3 months. This can even include a home of your close relative also. Next, work tie. Are you substantially working in UK? Let's say 40 or more days at any time in the tax year. Next is 90-day tie. If you are spending more than 90 days in UK in either of the previous 2 tax years. Next, the last, country tie. If you are spending more days in UK than any other country in the tax year. But remember, if a person, okay, this country tie is only relevant to a person who is a UK resident in any of the previous 3 tax years. But if you're not a UK resident in any of the previous 3 tax years, let's say you are a person who is coming fresh, first time you are coming to UK, a person arriving in UK, this country tie is ignored. You can't have any link with UK before you arrive in UK. If you are first time arriving in UK, so you can't be a resident in any of the 3 tax years, and you are arriving in UK for the first time. So country ties in note, we take the other 4 ties: family, accommodation, work, and 90 day. Okay. But if you are UK resident in any of the previous 3 tax years, we take the country tie also, all the 5. If you are not UK resident, only the first 4 ties: family, accommodation, work tie, 90 day. Now, this example. So there are 3 people given to you: A, B, C. Anna, Ben, and Charles. Okay, this is like a question example. And by the way, let me tell you what is the source of my material that I'm using on the screen for my lectures. The materials that I've taken this time is not from the Kaplan textbook, which I always used to do for my previous lecture. From this year onwards, I'm going to take all the materials from the ACCA Study Hub. But doesn't matter whether you go from Kaplan or BPP or ACCA Study Hub, the materials, the resources, the main content are all the same. Maybe the way of words, the way of presentation is different. So it's the same. So that's why any question that is there that ACCA Study Hub have used, I picked up, copy pasted questions with the answers so that anyone could use it. Why? Because everyone is not using ACCA Study Hub. Everyone does not have it's not a book. It's given online. Unlike Kaplan, where someone might have the textbook, they will have the questions and answers with them. So even if I don't give the questions, they have the questions with them. But ACCA Study Hub, not everyone has these questions. Even if they have the question, they might be looking for the answers. So I don't want to create any trouble for my viewers. That's why I've copy pasted. I've taken the time, copy pasted the answer. Okay. So now Anna, not previously resident in UK, was present in UK for 42 days. So tell me the answer. This is the answer. By the way, next line is the answer. First one is the solution question. Next one is the answer. Tell me, he'll be UK resident or not? First, we'll go through the less than 16 days, but this is 42 days. It's less than 46 days. Less than 46 days. Under the first test, automatic non-UK residency test. Remember the first test? And the second point, less than 46 days. Because, so, less than 46 days, and she was not previously resident also. So, automatically will be treated as non-resident in UK. Okay, not previously resident and less than 46 days. Next, Ben. Ben, 60 days working in UK. He stayed at his family home in UK. Okay. So here, looks like he's UK resident. Why? Because he has been in UK for too long to be automatically non-resident. If his UK home is his oldie home, we don't know whether it is his oldie home or not. Information is not given. But if it's his UK home is his oldie home, automatically he'll be UK resident. But if he has other home abroad that he uses, then the residence will be determined based on the number of ties and previous status. So we still don't know. Okay. Coming to Charles. Charles is a UK resident, was a UK resident. In this, you see previous tax year. This is previous tax year. He's a UK resident and working full time. But in April 2024, purchased a property abroad. Most of the year he stayed there only. But from Jan to March, he spent 60 days in UK. 42 of them are working. Okay. Charles had no family in UK. So they are giving all the ties. Okay. So tell me, he has an overseas home and 9-month absence. He will automatically be UK, not to be automatically UK resident. Okay. If you go by automatically non-UK residency test, automatically he will not be UK resident. Now let us go through the ties. There are three ties. One is accommodation, one is 90-day, and one is work. But he does not have these two ties. No family, no country. But he has a house there, he worked there, and 90 days is there. Okay? And will therefore be UK resident because 3 days. How this depends based on that table. How many days he was working and what are the ties. And he was previously UK resident also. So based on that table, he has decided he is a UK resident. There is a note to it. If Charles had arranged his work only 8 days, okay, he would only have two ties and would not therefore have been treated as a UK resident. This is based on that table. To come to this stage, you need that table with you. Otherwise, it's very easy. Okay. Now, residence of a company. Now, from individual, we are moving to company. Here, UK resident companies are charged to corporation tax on worldwide profit. Okay. A company is resident in UK if it's incorporated in UK or it has a central management and control of company in UK. Very important, these 2 points. You need to memorize it. Okay. But here, certain exceptions are there. Okay. We'll see that. Now, what is the central management and control means? One who is having the highest level of control in a company. Could be a parent company, parent on a subsidiary, okay? Or could be the board of director. So company that has not been incorporated in UK, to check the residency of that company, you have to check where the central management and control are practiced, exercised. If it's exercised in UK, see it's an or condition, this or that. If it's not incorporated in UK, but it has central management and control exercised in UK, it will be UK resident. One of them. If it's an and condition, both has to be met. Coming to the next, double taxation agreement, very important. If you are having overseas and this, why double taxation? A person might have dual residence. Company also might have dual residence. They might have residence of two countries at the same time. Resident of UK also, resident of another country also. Then what happens to the source of income and gain? They will be charged to income tax under both the countries, right? So that means you are charged on the same income or same gain twice. Double taxation. That's why there are some agreements in place to avoid this. Okay. Double taxation agreement aims to ensure that tax is paid only once on that source of income, profit, or gain. On the same income, you will not be taxed twice in two different countries. Double taxation agreement aims to prevent that from happening. So now, the agreement will specify which territory has the right to tax. Okay. So that means a company might pay tax in the country of residence and get exemption from the other country where he is not a resident. Okay. He might pay the tax in the country of residence and get an exemption or relief where the income arises. Income might arise in some other country. There he might get exemption or relief and pay tax in the country of residence. Or pay tax in the country of income source. From the country where the income is coming, pay tax there and get an exemption or relief in the country of residence. Other way around. What happens when no tax treaty exists? Then UK allows unilateral relief. This avoids double taxation. Here, you are paying tax in overseas, but you are getting a equivalent tax credit in UK for it. You are getting tax credit on the lower of the two tax that you have paid. UK tax on the overseas or overseas tax paid. Whichever is lower on that, you are getting a tax credit. Okay. Now, the structure of UK tax system. So we are finished with all. Now we are moving on to the structure. how UK tax system are administered, the structure. So here, as I told earlier, the responsibility for assessing and collecting UK tax falls on HMRC, HM Revenue and Custom. They administrator, they collect the tax. Okay. They also administer child benefit and tax credit. Also, they're responsible for national minimum wage enforcement and recovery of student loans. Taxpayers can appeal against any decision made by HMRC within certain time limit. See, it's not that HMRC's decisions are always final. As a taxpayer, there's a flexibility that they are giving you. You can appeal against the decision made by HMRC. If you are not happy with the decision by HMRC, go and appeal. But that appeal has to be within certain time limit, not any time you want. And after the initial appeal to HMRC, after you have appealed to HMRC, then you can go to the first tier tribunal or upper tier tribunal. I'm going to go through this later in this chapter, which deals with more complex case. If it's an upper tier tribunal, they deal with more complex cases. If it's simple, mostly it is dealt in first tier tribunal. Okay. Now, tax authority. HMRC is a non-ministerial government department. They are accountable to the chancellor of the chancellor. Okay, operating under the oversight of treasury. For MCQ purpose, all these are needed. Otherwise, you don't have to write all this. Okay, tax authority will not ask questions on all these things. But for MCQ purpose, they might ask you rules of HMRC, what is HMRC, what are the functions of HMRC, and things like that. Now, so the legal powers and responsibilities of the department are vested in HMRC commissioners, and these commissioners exercise their functions in the name of Crown. For governance purpose, okay, there should be a governance. All of us know what is governance, right? From our earlier studies. So for governance purpose, there should be a system of governance also. Tax authority, otherwise they will work on their own as they wish. They might become a monopoly. So for governance purpose, the department's reporting, their performance, their strategic direction are reviewed by board of both executive and non-executive member. Even HMRC's duties are reviewed by executive and non-executive member. Now, self-assessment. All taxes except inheritance. So, basic principle for all the UK tax system is self-assessment, where the taxpayer makes regular tax returns or declaration. They make it once a year for income tax, for capital gain tax, and for corporation tax. And at the end of each tax period for VAT, that means every 3 months. And they calculate their tax liability, including any CGT payment, capital gain tax payment on account. Sometimes you have to pay in installment for some. Okay, we'll see later what are the conditions required to pay an installment. So payment on account, if you are disposing a residential property, you pay capital gain tax, but that capital gain tax is on account, and you pay the tax due unless already collected at source. What is the meaning of collected at source? Most basic example of tax that is collected as source, what is it? Employees income, employees income tax, employees NIC. They are paid before employees are given their salary. From their employees salary, their income tax, their NICs are already deducted, and then it's given, net salary is given to them. This is known as collected at source. Unless other income where we are receiving it gross, then we are calculating tax and then we are paying. But for employees, their income tax are already deducted at source. It is pay as you earn. Okay, so pay the tax due unless it is collected as source. If it's collected as source, you don't pay the tax, already it is deducted. When is it done? You pay the tax by the due date set by HMRC. HMRC have set a due date for each type of tax. You have to know this due date, is very important. Next, so Each person has to submit a personal tax return and complete separate tax computations for each tax year. Remember, husband and wife, they are separate person in term for the purpose of tax. Husband might have an income, wife might have an income. Their income are not joined together. Rather, both of them are chargeable to income tax, whatever type of tax. They're treated as separate person. Now, for if it's a company, you have to pay a corporation tax return. Even see, even if you're a member of a group of a company under common ownership, one company might pay all the tax, right? Sometimes you might come under the group, you might go for the group, right? A one company responsible might pay the tax. Still, you have to calculate your own tax return. It's important. Sometimes HMRC investigates into the separate company under the group. That's why you need it. Deduction at source. This is applied for some income and NIC. Mostly other types of income are not deducted at source. Okay. So your income is deducted by a third party before it is made available to the recipient. As I told you, pay as you earn. This is mostly for the salaries of the employees. Okay, it is related to income tax and NIC on the wages and the salaries of the employees. It's deducted. Next. Now, coming after the payment of tax, there are certain reliefs that an individual or companies are eligible to. They can claim for this relief. Or sometimes you might claim for loss. If you're having a loss, you're going to get some relief. So you can claim for this. And some specific tax treatments also there. You can claim for this. When should you claim for this? Within 4 years of the end of. Unless another time limit applies. Sometimes they might give you some time limit. If they don't give, if they are silent, all claims, whether it is for reliefs, specific tax treatment, losses, must be made within 4 years. 4 years is very important. Within 4 years of the end of tax year, if it's income tax and CGT, end of accounting period, if it's corporation tax, or end of tax period, if it's VAT. 4 years after all this. Next, inheritance. Self-assessment does not apply to inheritance. Instead, a relevant person has to disclose information relating to their lifetime transfer when they were alive, whatever the transfers they have made, and a person's state at death. And then HMRC then determines the amount of tax due. It is the HMRC who determines what should be the amount of tax due. That's why it's not self-assessment. Who are the relevant person? Could be the transferor of the asset or the transferee. And personal representative of the deceased person. Obviously, if a person died, how can they pay? Their personal representative will pay the tax, right? Now, relevant person are responsible for paying IST by the due date set by HMRC. It is the transferor or the transferee or the personal representative. Now, these are the responsibilities of HMRC. For MCQ purpose, you need it, okay? And also for ethical issues. Issue all the tax return. HMRC issues all tax returns. They review these returns. They might conduct some compliance check into the content and accuracy. They manage the collection of taxes. They impose interest and other penalties for late payment of tax, late payment of returns, incorrect returns. Okay. Now, professional tax advisor. A taxpayer sometimes they might appoint an accountant or a professional advisor to complete their tax return and agree their tax liability, and then they deal with any dispute with HMRC. Okay. Mostly self-employed person do this. They employ some professional assistants. Okay. Or sometimes companies might have their own accountant also prepare. They do this for them. Okay. But mostly wealthy individuals who have a very complex income structure, Okay, they might use professional advisor. For them, it's valuable because professional advisors are very expensive. Not any person can deal with them. Okay, their charge is very heavy. So mostly wealthy individuals will hire it. Big companies, small companies might use their own accountant or things like that because their income structure is not so complex. It's easy to calculate. They might have one or two sources of income. Now, professional advisors have to exercise their duties competently. They must have to regard to the conflict of interest. They should not benefit personally. The only benefit that they can have is their fees that they are charging for the services that they are giving. Then they should keep proper records of their dealings with the client and HMRC, and they should act in an ethical manner in accordance with the principles established by HMRC. Confidential, professional behavior, professional competence, due care, integrity, objectivity, all the five codes of ethics have to be applied by professional tax advisor as well. Now, so the main professional bodies have issued guidance on the procedure to be followed in the event of a possible irregularity. If a client's tax affairs are irregular, professional bodies have given you some guidance what procedure one should apply. Then, this is very important from the point of an ethical question. Remember, one ethics question you will get in ACCA. Okay, advisor, whoever is the advisor, you should explain the situation to your client and recommend disclosure to HMRC. If the client refuses to disclose after you are pursuing them, you should give them a formal written advice, giving them the consequences. And if still they don't do, remember it's a tax offense. Okay, tax offenses can lead to money laundering. If you're deliberately refusing to correct any known error, it can include a tax evasion. Now, so if the client still do not authorize disclosure, advisor then cease to act. And also, you just can't go off. You have to advise your client that you're no longer acting for them. You have to notify HMRC that you have ceased to act for the client, but do not disclose the reasons why. And if you feel it's appropriate, you have to consider whether you have to advise HMRC whether they can rely on any accounts. Okay, so whether to advise HMRC that accounts or statements carrying a signed report can no longer be relied upon. Then you have to respond in a professional and a careful manner. Okay, you have to be very careful when you're dealing with any professional clearance letter from the subsequent advisor. The advisor is coming after you. They might ask for a professional clearance letter for the client that they are going to work for. You have to be very careful when you are responding. And then you have to consider whether you have to report this matter under the money laundering regulations. At least it's a good practice to at least refer this issue to money laundering reporting officer MLRO within the advising members firm. Every members firm should have MLRO. Make sure that you at least refer the issue to them where you are ceasing to disclose, ceasing to act for your client. Okay, this is an example. Example 2, intention to underpay tax. Your intention is you are going to pay less tax. Okay, let's say Anthony. So Anthony is telling his tax advisor that his intention is to underpay tax. Okay, so this is a tax evasion. It's an example of tax evasion and money laundering offense also. Both the types. What should the tax advisor do here? He should apply his professional body's ethical guidance. That means ACCA, as an ACCA member. As an ACCA member, ethical guidance he has to apply. He has to persuade. Number one, first step is always persuade the client to comply with the law. If still Anthony does not listen, they should consider whether they should act for the Anthony or not. Now, tax evasion. Remember what is tax evasion. These definitions are very important because if you don't know the definition, you cannot answer the big questions. Tax evasion is illegal underpayment of tax, either through fraud, you are doing some fraud or negligence. Example, how do you do this tax evasion? You are not disclosing your income, you are not disclosing your chargeable gain, you are not disclosing your transfer. You are making a false return, and you are deliberately failure to submit return. You are not submitting return on time. You are giving false return. All these are examples of tax evasion. Tax avoidance, on the other hand, is a tax form of tax planning. You are still minimizing tax, but through some legitimate tax planning systems. Tax avoidance is not illegal, and it's within the tax, making sure it's within the limit of tax law. Okay, but sometimes, generally, how do you avoid tax? Through tax planning. You utilize the tax relief. You make sure you're utilizing the exemptions that HMRC is giving you, and ensuring the lowest rate of taxes paid to your income, gains, and transfer, and also for VAT. All these are acceptable. They are legal. Even though they are legal, sometimes this tax avoidance arrangement also becomes too costly for the government, or sometimes it's running against the intention of the law. What is the intention of the law? Was something else, but your intention is something. You are trying to play with the rules. Okay, there's a loophole there. Okay, where you are taking the tax advantage. So remember, if HMRC finds this, then the tax advantages that has been given to you through this arrangement will be removed by them changing the tax law, known as anti-avoidance legislation. That's why they have introduced this. General anti-abuse rule. That's why we are coming to this. That's why they have developed this. This was not there before. So, as an addition, the Finance Act 2013 introduced a code to control a whole general class of tax avoidance. This is a mechanism to control the tax avoidance arrangements. Okay, this measure is called GAR, or you can say JAR, General Anti-Abuse Rule. Where you're going to abuse, they want you not to abuse. Okay, wherever they see that this tax arrangements that you are taking to avoid tax is abusive, they're putting rules. Okay, so they're challenging those arrangements. It is okay. That means they are challenging. They are saying that this action is not reasonable. It's not regarded as a reasonable course of action. If they come to that conclusion that it's not a reasonable course of action, then effect of see, if it's a reasonable course of action, no issue for you, no problem. If it's not reasonable, then the issue comes. Then the effect of this is to make adjustments. Then you make adjustments that are just and reasonable. That means whatever the advantages that you are getting under the scheme, now it will be taken away from you. Counteract. So this was developed with a wide degree of consultation with the tax profession and other interested parties. They have developed this. Okay, their main aim is to deter the implementation of abusive scheme. They want you to avoid these abusive schemes. Now, statute. Sources of the tax law, where the tax law comes from. First is statute, government. Each year, statute is your finance act. Each year, one finance act, sometimes more, is passed. Sometimes they are extended, sometimes they are reducing, sometimes they are modifying the existing law. What is the last act relevant to this exam? That is your Finance Act 2024 and Finance number 2 Act 2024. Okay, now statute. So now, see, this is relevant again for your MCQ. Okay, they will not ask you a written question on this. So when appropriate, the cumulative total of Finance Act is consolidated into Unifying Act. This Unifying Act now comprises the following. Okay, all this you don't have to know the details. Detail will not be asked. So do not Google and check. First, Inheritance Tax Act 1984, Taxation of Capital Gain Tax, Social Security Contribution Benefit Act, VAT Act 1994, Capital Allowance Act 2001, Income Tax Earnings and Pension Act 2023, Income Tax Trading and Other Income, Income Tax Act 2027, Corporation Act, and Taxation, International and Other Provision. All this comes under statute. Okay. Now, case law. Second source is case law. Here, judgments are made in the High Court, Court of Appeal, and the Supreme Court. They might modify or they may add to the body of statute law. First is statute law. Then comes the case law. Third, HMRC statement of practice as extra statutory concessions. So these are issued by HMRC, again helping you to interpret the meaning and application of the statute law. And extra statutory concessions, they are provisions, they are relaxing the strict applications of the law. Because sometimes, not in all the conditions you can apply the strict law. It will lead to hardship. It might lead to anomalies. Then they relax these rules. So extra statutory concessions does that. That is the purpose of it. You don't have to know the details. This much is enough. So with this, I have finished the first lecture in tax, UK tax. So what is the syllabus coverage? Under this, we have covered section A. You can also get out the detailed syllabus from your ACCA website. You can download it. I've already covered the section which I've covered in this lecture already. Section A, UK tax system and its administration. We have covered what is the function and purpose of tax in economy. Okay. We have explained the difference between indirect and direct tax. Indirect only VAT, direct are all the other types of taxes. We have identified capital and revenue tax. Revenue taxes are income, NIC, capital operation could be revenue or capital. Rest all are capital. Except VAT. VAT is not capital nor revenue. Then, second, principal sources of revenue law. What is the overall structure of UK tax system? Different sources of revenue law. HMRC. How HMRC is organized. The general anti-abuse rule. Okay, difference between tax avoidance and tax evasion. Tax evasion is illegal. Tax avoidance is legal. But if the schemes are abused, it's dealt under JAR. Then, UK system. How UK tax system interacts with other tax jurisdictions. The double tax agreement, where you are giving unilateral relief. Explain the need for ethical and professional approach. And second, section B. From section B is income tax and NIC. We have covered the scope of income tax, how the residence is determined for individuals. Then for corporation, how the residence is determined for individual, for the company. So that's it. Now let's summarize the key points. Okay. All that I've covered in this lecture. So the purpose of tax is to fund government expenditure and manage economy, mostly influencing demand. Direct taxes are your income tax, NIC, capital gain tax, inheritance, corporation. VAT is only indirect. Capital gain tax is on tax on assets. Own revenue is on income and profit. Income tax applied to individuals, those who earn profits from unincorporated business. A multi-stage statutory residency test are determined whether individual or company is UK resident or not. Okay, a resident in UK is taxed on the worldwide income, and non-UK resident is only taxed on UK income. Married couples are separate taxable person, and withholding for income tax and NIC are made at source. That means it is deducted at source, income tax and NIC for employees mostly from their salary. Capital gain tax are on the sale or gift of assets. Inheritance tax is when you are transferring your capital asset to the individual on death or lifetime. Corporation tax applies to the taxable profit of the company. Next, a company is resident in UK if it is incorporated in UK or central management and control is exercised in UK. An UK resident company pays corporation tax on worldwide profit. There are claims for certain reliefs, losses, which must be made within 4 years of the end of the applicable period for each type of tax. VAT is an indirect tax on goods and services by both unincorporated as well as incorporated companies, and it's normally for 3 months. The tax year runs from 6th April to 5th April for income tax, CGT and NIC, and for corporation tax it is 12 months, and it cannot exceed 12 months, 1st April to 31st March. And HMRC is responsible for collecting the tax. Except IST, all are self-assessment. Tax avoidance, where you legally minimize the tax through tax planning. Tax evasion is illegal. And what are the sources of revenue law? Statute and case law. And GAR aims to counteract the tax advantages that are arising from the schemes that are considered abusive. Not all schemes are considered abusive, remember. And double tax between states aim to ensure tax is only paid once on that source of income or gain. So, what are the technical articles that one must read? For your Finance Act 2024, there are no technical articles on this lecture. Okay. For more, you can visit your ACC Global website to access the relevant articles. Thank you for watching, and I shall see you in lecture 2 of tax. Again, it's covering income tax in detail. So make sure that you subscribe to my channel if you haven't subscribed, and make sure that you share this content with many of your friends as much as possible before the exams approaches. Thank you, and I shall see you in the next lecture.